Hi class, on to the next week, week 5. So far we've talked a lot about assets in this class. Last week we talked about both tangible and intangible assets, both property, plant, and equipment, and then trademarks, copyrights, patents, goodwill, among others. As you know, on the other side of the balance sheet, on the other side, assets are one side, and the other side there's liabilities and equity. This week we are focusing on liabilities, current and contingent liabilities in Chapter 13, and non-current long-term liabilities in Chapter 14. All of these liabilities, in addition to the equity, in a sense help fund the company, but it's important to note not all of these liabilities represent investment funds made by investors, like debt that a bank loans or debt that a bondholder owns to make money and to invest in the company. Some of it comes from other sources like accounts payable, sales tax payable, payroll taxes payable, income taxes payable, interest payable, and accrued expenses. The presence of these non-interest-bearing liabilities means we've received some benefit, but not yet paid for them. In other words, the obligation exists, and that's what the liability represents. In a sense, they've been extending us credit even though some of these items don't charge interest. Some accounts payable, however, do charge interest, especially when the balance has been outstanding for more than 30 days. Anyway, a number of these don't charge interest, and they're known as what are NIBCLs, non-interest-bearing current liabilities. There's no interest expense associated with them, and they are due within 1 year. All these liabilities, however, represent claims on the assets. We've been given some sort of service, utilities, labor, even government services, yet we haven't yet paid for them. So that's what they represent. Now, the owners of a company, that is the equity holders, only have claims on the assets that exceed those liabilities. And because we know accounting convention or accounting is supposed to convey information as much as anything else, the underlying economics of the business it is reporting, that is, it needs to take into consideration even contingent liabilities. If a business, for example, has guaranteed a loan, there is a risk that the business may have to make good on that guarantee if the debtor defaults. Somehow, that promise to fulfill something, even if it hasn't yet been done or it just may be done, it has to be represented on the balance sheet, specifically on the liabilities, because that's what it is. It's a liability. It's not an expense. It may happen. Also, some businesses, for example, may have more legal jeopardy than others, and they have to represent the possibility of losses arriving from those lawsuits. And the financial statements did not include these contingent liabilities. It would both understate the liabilities and overstate the owner's claims on the assets or the equity. Somehow these contingent liabilities have to be quantified, and accounting convention tries to do that. Now, last week I was showing you the asset side of Bank of America's balance sheet because we were focusing on goodwill, an intangible asset. I wanted to show you it with a real company on a real company's financial statement that they released to the SEC and to investors. This week I'll take a quick look at Bank of America's balance sheet with a focus on the liabilities and equity side. However, we're going to emphasize the liabilities. Okay, you see here, as we saw last week, the total size of the balance sheet is $2.3 trillion. $2.3 trillion worth of assets and an equal amount of liabilities and equity there. The majority, though, of the funding for the funds these assets comes from liabilities. $2 trillion out of the total, almost, little shy of $2.3 trillion comes from liabilities. And banks, by their nature, oftentimes have less equity as a percentage of their assets than do other business, because if you think about what do banks do at their core, real banks actually take deposits and lend them out to the economy and to the economy. That's what their primary function, even though they perform other sort of transactions. This is specifically banks as opposed to investment banks. The deposits, and part of the reason why they show up on the liability side, the deposits are considered a type of debt funding. If you look right here at the line item here, the biggest line item for source of funding is part of the liabilities is deposits. It's 1.3 trillion, and that That's obviously larger than all the other sources of liabilities or other sorts of debt funding there, and it's obviously bigger than the shareholders' equity right there. Believe it or not, banks right now have a lot more equity than they did before the financial crisis. They were said to be a whole lot more levered before the financial crisis, and what that means is they had less equity relative to their assets, or you could say they had more debt relative to their equity. And that was pretty risky. So, the regulators forced them to increase the amount of shareholders' equity they hold, and that makes the banks a whole lot more less risky and therefore less risk to the overall economy. Our economy actually can deal a whole lot more easily with financial crises that are where there's losses to equity than they are when the financial crises are debt crises at the core. That's because debt losses to debt hits financial institutions a lot more harshly, and because those financial institutions have so many tentacles throughout the economy and they're so intertwined, that risk spreads, and that type of financial risk spreading is known as financial contagion. Now, we already said a lot of our current a number of our current liabilities, there is no interest expense or cost associated with them that we have to make regular payments on. That's not all of them, but that's the case with some of them. And however, also with respect to our long-term or other liabilities, that's the case with some of the ones, especially like contingent liabilities. And the balance sheet here, looking at a more detailed version of the balance sheet here than we saw the summarized version, you can even see right here here's the liabilities. So we have non-interest bearing liabilities here. We have other non-interest bearing liabilities here. We have accrued expenses here, and it even talks about commitments and contingencies. So you see that there. However, with the majority of our other sources of funding, and especially some of the longer term sources of funding, they come from investors who are expecting a return on their investment, whether they are banks lending senior debt, bondholders holding debt, buying the bonds and holding the debt, or equity holders. And regardless of whether the investors are individuals or whether those investors are institutional investors like mutual funds, insurance companies, pension funds, even corporations, or private equity or other. The total amount of funding from these investors who actually expect to make a return from their investment is called, that type of funding is invested capital. The mix of the sources of these sources of invested capital, from senior secured bank debt on one end, which is the least riskiest, to the most risky on the other side, common stock shareholders, that mix of funding is known as the capital structure. Businesses that are growing and tend to be a little bit more risky have fewer assets to loan against which to loan, and they are largely funded by a greater amount of equity. Equity tends to cost companies more because the equity holders are taking on more risk. Oftentimes, more established companies with strong cash flows and more assets against which to loan have more of their capital structure made up of debt. However, it should be noted that debt is cheaper than equity, largely because it has less risk associated with it, and also because the interest payments on it that the debt holders, that the company has to make, are deductible with the interest expense. As if you've seen on the income statement, there's a line item for interest expense, and so that actually reduces the net income, and they pay less taxes on the taxable income there. So just in summary, the equity holders bear the bulk of the risk. They are the first to lose, and that's why they are compensated the most when the company succeeds. All right, well, good luck with this next week as usual. If you have any questions, certainly let me know, and we'll talk to you next time. Bye.